What's up everyone, Dylan here. I wanted to do a video going over more of a macro scenario. So at the time of me making this video, the S&P and the Nasdaq had just recently made all-time highs. Since the April lows, it has been basically a V-shaped recovery where a ton of people have missed out on this recent rally. So there's a ton of people that continue to be bearish, that continue to miss out on the move that we've seen and continue to relentlessly try to short this market and counter trend the overall move and the flows that we have been seeing. So in this video, I'm going to talk about a macro scenario that can fuel the market much higher, okay? And to preface, I'm not saying that this is guaranteed to happen. I'm also not saying that this is going to happen overnight, right? This is more of a macro theme that can potentially fuel the market much higher in the next, 6 months, year, 2 years, so on and so forth. So for the people that are very, very one-sided in terms of having a clouded judgment that, where they only think the market is going to go down from here, hopefully this video opens up your eyes and shows you that there is a bullish case to make for this overall market. And also, I haven't seen a lot of people talk about these different pieces. So let's hop right into it. So can the market go much higher on a macro scale? This can be the biggest threat to bears over, the next 6 months, year, 2 years, so on and so forth. Okay. So there's 3 big ingredients for a macro bull case. 1 being upcoming rate cuts, 2 being underweight equity positioning, and 3 being poor market breadth. Okay, so first up, upcoming rate cuts. At the time of me making this video, the total money market funds are at a whopping all-time high of $7.4 trillion. And you could see on TradingView, right, the ticker symbol is this right there, right? This shows you an updated amount of total money market funds. And you could see, this is going all the way back since inception back in 1945. This thing has mainly been going up, and we are currently at the largest number it's ever been. Okay. On top of that, the current Fed funds rate is 4.33%, also shown on TradingView right here. Okay, so it got as high as 5.33% back in, between August of 2023 and August of 2024, and has since come off of that recent high. Okay, so what does this mean? Basically, that amount of money being in the money market funds, the vast majority of that money is making 4% APY. Okay, so folks are moving a whopping amount of money from the stock market into money market funds, and they are settling for a current Fed fund rate of, say, 4% APY. Okay, so Fed set. Right, the Fed is set to cut rates 3 times by this year, right, by the end of 2025, and then 2 more times in 2026. This would ultimately put the Fed funds rate at 3%. Okay, you can see this is from Charlie Bolello. Kind of just gives a timeline showing the market expectations for Fed funds rates and where it's going to be at the end of 2026 at 3%. Okay, this is just something else from Bloomberg showing that, the different FOMC meetings coming up, and then based on those FOMC meetings, the percentage of a cut at those particular meetings. And you could look at this yourself, and this is a great tool to use that updates on a daily basis. So anytime that there's data that comes out, inflationary data, growth data, right? The CME FedWatch tool will show you the changes in expectations for those Fed events. Okay, so if you start to see that growth is slowing, right, going forward, that will dictate how this looks Okay, so you could see, right, similar to what I was just showing you on that Bloomberg screenshot, right, the next rate cut or the next FOMC meeting, July 30th, they're not pricing in a rate cut, right? Currently, we're at 425 to 450. So it's showing that a cut is at that next FOMC, July 30th, is only a 21% chance of occurring, right? Whereas on the flip side, September meeting shows that there's a 72% chance that the Fed will cut rates, okay? And going forward, October shows a 54% chance of cutting, and then December shows a 45% chance of cutting. So this is far out, but clearly September looks to be the next time that the Fed is going to cut rates. So we'll definitely keep an eye on that. And again, you guys can, you all have access to that tool as well. Okay. So what does this imply, right? Where am I getting at? I'm getting at the scenario where there could be a ton of FOMO coming into the market, right? So by the end of 2026, right, if those Fed expectations are correct that the federal funds rate will be at 3%, right, considering how many dollars, right, how much money is in the money market funds, right, you got to wonder and say, are those amount of people going to settle for 3% on their money, right? Many investors have missed out on the recent rally since April, right? And again, they're currently making 4% on their money APY. Yet, if you look, right, SPX since April lows are up what? I mean, this isn't a perfect world, but from the bottom of April lows to where they are now, the S&P has rallied 28%. Yet folks are settling for 4% on a yearly basis. So again, there's a massive opportunity cost staying in those money market funds, okay? So very, very, very important. The lower the Fed funds rate goes, the less appealing it is for folks to stay in the money markets, right? Because, 3% still to some people might be worthwhile. So because it's risk-free, right? They don't want to put their money in the S&P, which can potentially go down 10%. Why would they want to put their money in a risky spot that can potentially go down 10, 15, 20% when they are able to make 3% guaranteed, okay? So that's the thought process that these folks have. So as a result, right, the lower that Fed funds rate goes, right, 3% by the end of 2026 as of current expectations, right? Beyond that, it'll go 2.75%, 2.5%, 2%, so on and so forth, right? The lower that goes, where's all that money going to move? Once it gets to the point where it's not appealing to stay in those money markets, right? It's going to go to the stock market. And we've been seeing that in the recent weeks, right? Here's a picture from JP Morgan, it came out this week, right? Where this shows the 4-week, right? The over the last month, week by week, US ETF flows, right? So you could see the first and second weeks of June, only $800 million went into equities the first week of June. Then the second week of June, $1.7 billion worth of US ETF flows went into equities, right? Then the third week, look at that staggering jump, right? We're looking at the blue, right? We're looking at equities. We're not looking at fixed income or other, right? Look at that massive jump. So why did that happen? That happened because the S&P was nearing all-time highs and people started to get FOMO. They're like, oh my gosh, we've been settling for 4% APY since April and the market has rallied 28% in the S&P. What are we doing? We got to go back into the stock market or else we're going to miss out on a much bigger move. Okay. And again, that's not just the third week, but also this most recent week as well, right? So you could clearly see that the FOMO is starting to settle in already. Okay. And again, the higher the market goes, the more likely that FOMO is going to increase, where that $7.4 trillion in the money markets could potentially trickle its way into the stock market. Okay, hopefully you guys understand. I mean, this is a massive thing to think about. Okay, so now some of you guys might say, oh, well, Powell has been very, very hesitant to cut rates. I don't think that the rates are going to be cut 6 times over the next year, year and a half, right? So I would beg to differ because of the shadow Fed. What is the shadow Fed? This has only been coming up recently, I would say in the last 3-4 months, right? I've never heard of this particular term beyond this year, but this is what it is, right? So Fed Chair Powell has been hesitant to cut rates despite Trump constantly pressing him, right? There's been tons of headlines saying that Trump is looking to fire Powell because he doesn't know what he's doing, right? There's been a lot of bickering, mainly on Trump's side of things, right? But that's besides the point. President Trump will likely appoint Powell's runner-up very, very early. Okay, so Powell's term doesn't end until May of 2026. So rather than wait all of that time, almost a year's worth of time, right, this is what Trump is going to implement. So considering the administration cannot fire Powell, their solution is to implement the shadow Fed, where the replacement will provide dovish forward guidance and undermine the Fed's still high interest rates, right? Ultimately pushing rates lower, which should send stocks higher because of what I just went over on the previous slide. Okay, so Trump knows that Powell is taking his time, right? And he has, with all due respect, Powell has his reasoning, right? He wants to see the result on the effects that the tariffs are going to have on growth, right? He doesn't want to jump the gun and do it too early because that can create bigger problems to come. So rather than waiting for Powell to end his term, Trump is going to roll in the replacement that is eventually going to take over Powell come May 2026, and that person is going to do interviews and show that they're going to implement dovish actions once Powell leaves. So they're basically front running Powell's ending term. Okay, that's very important. So the people who think that Powell isn't going to cut rates anytime soon, that shadow Fed basically makes this whole understanding possible, that and for it to happen much quicker. Okay, so the next thing is the fact that equity positioning is underweight. Okay, so despite the S&P and the Nasdaq being at all-time highs, many investors are underweight equity holdings. The market pullback from late February to early April spooked a lot of investors. Many of them have not added back the length, right? They have not added back those holdings, right? They were likely selling on the way down, right? Out of panic, out of fear. Oh my gosh, the market's crashing. What is Trump doing? He has no idea what he's doing with all these tariffs. Oh my gosh, I got to get out of this. My 401k is down 20%, right? There's all this panic and fear happening. Since the April lows, there have been folks who continue to sell their long holdings, and also some stubborn shorts who relentlessly continue to short and short and short as the market goes higher and higher and higher. Okay. Last week, Bank of America research reported that $26.1 billion went to cash in their weekly flows. So this clearly shows that folks are getting out of their long equity holdings and going into cash or money market funds, right? That's why it keeps going higher and higher, and it's currently at $7.4 trillion, right? Despite all the negative headlines we've seen, the market remains resilient. Some of those headlines include higher tariffs growth momentum cooling, no Fed rate cuts this year, right? Higher debt and deficits, right? The big beautiful bill, reduced 2025 earnings, geopolitical tensions, right? I could go on and on and on and on. And this is why people are so bearish and continue to think that the S&P is due for a crash, okay? So the higher the market goes, the more likely those folks will have to chase. Okay, so here's some, so I have two pictures coming up, right? This is the most recent positioning from the CFTC Commitment of Traders report, which is public knowledge. You could go on there and look for yourself, right? All you do is type in COT report, right, on Google, right? And you click that top one, Commitment of Traders. Then you go to CME, right? Where is it? CME. Chicago Mercantile Exchange. You can do short format, go down to the S&P futures, and you could see this. This is just a visual of what you are going to see on there. You could see, despite the market going higher and higher and higher since April, the positioning from non-dealers U.S. equity futures have been going down. So that's exactly what what I was just saying. People are either shorting or getting out of their net longs, right? And despite the S&P and the Nasdaq at all-time highs, that positioning is declining, right? That's totally opposite of what should technically happen, right? Another thing is the fact that equity positioning has risen significantly off the bottom, right? But is still so far below February levels and remains underweight. This is from Deutsche Bank, right, from just this past Friday, June 27th. So again, where the positioning was at in February was much higher than where it's at currently. So, and it's at the 30 percentile since 2010, which, 30 percentile is very, very small relative to where it should be, being that S&P and the Nasdaq are at all-time highs. So a lot of people are underweight. And that's not just individual investors, that's funds, that's hedge funds, that's portfolio managers, so on and so forth. So a lot of people continuously remain very, very pessimistic of this market, and they don't think that the market is going to go much higher from here. And again, the higher the market goes, the more likely those folks will have to chase and ultimately, set up for a further short squeeze, a further chase of momentum to the upside, and so on and so forth, right? More buying pressure coming into the market, potentially, okay? The last thing is poor market breadth, okay? So market breadth refers to the number of stocks advancing versus the number declining in a specific market or stock index. So it's basically the net difference between the stocks that are going up relative to the stocks that are going down, okay? The top 10 companies now account for a record 38% of market cap and a record 30% of profits, okay? That's from Peter Oppenheimer out of Goldman Sachs, right? In other words, only a small percentage of companies are fueling this market higher. Okay, the S&P and Nasdaq are at all-time highs, yet the Russell is 12.3% below all-time highs, which show just one example of many that there are certain sectors and certain names out there that have not been participating in such a large rally, being at all-time highs. So some would argue that this is bearish as it builds reliance on a small basket of companies, right? Meaning that, like, if there's only 10 companies that are fueling this overall market rally higher on the S&P and the Nasdaq, you could argue that it's bearish because if those 10 companies start to underperform, you could argue that the overall market is going to suffer because those 10 companies are going to be removing that source of support in the overall market. However, Goldman Sachs begs to differ. So their angle is this. Goldman argues that it will set the stage for the lagging names to catch up, right? In that the other, call it 70 or 62% of the names that have not been participating are going to start participating and catching up, where they're going to pick up some of the slack. If the top 10 companies start to underperform, the other vast majority of companies that have been underperforming are going to be able to absorb that underperformance in the top names. So that's what they're saying, okay? So will the rally broaden, right? So you could see this is from Goldman, right? S&P 500 52-week market breadth is awful. But mark our words, this is bullish, as it is given that this rally will broaden. Okay, so I literally just took their words from that particular screenshot, and you could see, right, the breadth is going down, right? It's literally been declining despite the S&P and the Nasdaq at all-time highs. So that shouldn't be the case. Usually if the breadth is so bearish and going to the downside, where more stocks are declining as opposed to going higher, that should technically mean that the market is going to also drop. But in this case, because it's the heavier weighted names, right, the mega cap magnificent 7 names that have a ton of influence and a ton of weight in the market that are outperforming, they're able to pick up the slack from the companies that are doing poorly and going lower. So that's that, okay? And then the other one, this is a crazy statistic, right? 22 SPX stocks are currently at all-time highs, right? 22 out of 500. That's insane, right? So this chart or this diagram shows previous S&P 500 breakouts to all-time highs and the number of stocks at all-time highs in relation to those breakouts. So you could see this particular one is way crappier in terms of market breadth than the other ones, right? The last one, right, the last time that the market broke out, January 19, 2024, there were triple the amount of stocks within the S&P 500 that were participating in the rally being at all-time highs. So you could clearly see that the vast majority of names within the S&P 500 have not been participating in this recent run-up. So, but again, Goldman Sachs thinks that this is ultimately bullish because the stocks that are lagging will ultimately catch up and make this rally much broader. Okay, so will that be the case? Will it not? I don't know, but it is an interesting perspective. Again, I have to respect that they think that. Okay, so is this all a recipe for a melt up, right? The ingredients I've gone over have the ability to push the market higher, right? Macro. Okay, many folks have had a bearish bias since April, so hopefully this video opens your eyes. This will not happen overnight, right? In other words, it's not applicable to scalpers and day traders, okay? Rather, it sets up for a hypothetical macro case, okay? The ability that the market can potentially go much higher in, a larger macro viewpoint, right, or perspective. So again, the folks who are very, very bearish and continue to double down, triple down, quadruple down in terms of shorting the market and being very, very pessimistic about the overall market, and have been, cash in their 401ks and Roth IRAs and stuff like that, and been, sitting cash in money market funds, getting 4% on their money since April, missing out on a 28% move to the upside in the S&P in just under 3 months, right? This is the video for you guys to hopefully open up your mind, open up your eyes in terms of the potential that these certain ingredients or certain pieces of context have on the overall market. If you guys like this video, give it a thumbs up. If you like more of these macro scale ones, let me know. I know the vast majority of my channel is just like very, very short-term intraday stuff, maybe some trade recap videos in there too. But if you guys like this type of stuff, let me know, and maybe I'll do some other ones. All right, but that's it from me. I will cut it there, and feedback is always appreciated. I will talk to you soon. Peace.